Like and subscribe to my channel and click the bell icon to get new video updates.
Analysis: banker bashing keeps lenders profit averse. This is confusing because interest has been the wind in their sails lately. The Bank of England has raised its official interest rate from less than 1% a year ago to 4% now, prompting a sharp rise in banks' profits from loans and deposits in 2022. Inflation may have stopped accelerating, but it's not going away anytime soon, and interest rates are set to rise as much as 4.8% this year, based on market prices. As of Monday afternoon, UK banks are cautious about the further benefits they will reap. Their stance reflects similar uncertainty among lenders in the US and Europe. Investors reacted to a stream of strong full-year results from UK lenders in recent weeks by selling shares of most major banks due to their bearish outlook on earnings gains from higher borrowing costs. Competing lenders were NatWest Group plc and HSBC Group plc, are also conservative in their guidance, but analysts have yet to lower forecasts, suggesting they aren't quite buying the pair's lowballing. Several things are happening here, but one of the key issues is that the current environment is deeply unfamiliar to many bankers, investors and analysts. We've never seen interest rates go from near zero to anything like normal before, said Joseph Dickerson, an analyst at Jefferies. So depositor behavior is hard to predict. At the same time, the memories of rescue operations and crimes remain in the media and politics. Every increase in construction financing costs and every cent that is not paid to savers is reason for sharp criticism. There have even been calls for the BO to stop paying banks interest on their reserves, which appears to be a taxpayer-funded reward for doing nothing. But the potentially chaotic consequences of this for money markets, interest rates and inflation are important. As I have written, however, none of these explanations imply that the banks will definitely overshoot the forecast. Banks make money from higher interest rates in two ways: from the margins on mortgages and other loans, and from managing all the liquid cash made available to them on deposit. During the economic chaos unleashed by Prime Minister Liz Truss' short-lived government last autumn, UK banks had big reasons to worry about the threat of loan defaults, particularly on credit cards. Britain looked like it was headed for crisis, but much of that damage has since been reversed. Life is not easy for many, but unemployment is unlikely to rise much, so bad debt should be kept in check. On the other hand, things haven't looked so rosy for deposit returns for a long time. Banks make money here by paying depositors less than they receive from the Bank of England in interest on their reserves, or than they receive on portfolios of short-dated government bonds.